So, you're investing in the Indian stock market? Well, you've come to the right place. Today, we're going to untangle the world of capital gains tax. These are the rules you absolutely have to know to understand how your profits from shares get taxed.
You know that feeling, right? You make a fantastic trade, you see that profit in your account, and then this little voice pops into your head. Uh-oh, is the tax man going to come knocking? Well, let's make sure you're ready and feeling confident about the rules. When it comes to the tax on your share profits, everything, and I mean everything, hinges on one simple thing: time. How long did you hold the share? If it's less than 12 months, that's a short-term capital gain, and you're looking at a 15% tax. But if you hold on longer than that, it becomes a long-term capital gain, taxed at 10%, and only on profits over one lock. And trust me, that difference can really add up.
Okay, first up, let's talk about the sprint. You know, those trades you get in and out of quickly. This section is for all you swing traders out there and for anyone who likes to act fast when the market moves.
So there are two things you've got to remember here. First, obviously the holding period is less than a year. But second, and this is a detail that a lot of people miss, that special tax rate only counts if the Securities Transaction Tax, or STT, was paid. Now, the good news is your broker usually deducts this automatically, so for most of us trading on the major exchanges, this box is already ticked.
And here it is, the magic number for your short-term profits, a flat 15%. That's it. No complicated slabs, no confusion based on your income. Just a straightforward 15% on whatever gain you made. Nice and simple. And for those of you who like to know the nitty-gritty, this isn't just some random rule. It's written right into the law, under Section 111A of the Income Tax Act. This is the official section that gives you the benefit of that clean, flat 15% rate.
Let's make this super real with a quick example. Let's say you bought some shares for 1 lakh rupees. 6 months go by, you sell them for 1,20,000. Your profit? A cool 20,000 rupees. The tax is just 15% of that profit, which works out to 3,000 rupees. See? Simple, right?
All right, we've covered the sprinters. Now let's talk about the marathon runners of the investing world. This is all about the rules for gains on shares you've held patiently for over a year. So, rule number 1 is simple. You have to hold for more than 12 months. Now, if you've been investing for a while, you might remember these gains used to be totally tax-free. Well, those days are over. Another really important thing to know is that you don't get what's called an indexation benefit. That just means you can't adjust your purchase price for inflation like you can with other assets.
But here's the really good news. The government gives every single investor a pretty powerful exemption each and every financial year. The first 1 lakh rupees of your total long-term gains are completely 100% tax-free.
So what happens to the profit you make above that 1 lakh exemption? Well, that gets taxed at a really friendly rate of just 10%. And that's the key takeaway here. You are only paying that 10% on the amount that goes over the 1 lakh mark. And just like its short-term cousin, this rule has its own specific address in the tax code, Section 112A. This is the law that officially lays out the 1 lakh exemption and that 10% tax rate. Let's run through another quick example to see exactly how this plays out. Imagine that over the course of a year, your total long-term profit from selling various shares adds up to 1,50,000 rupees.
So the very first thing we do is apply that fantastic annual exemption. We just subtract that tax-free 1 lakh rupees straight from your total profit.
And just like that, after the exemption, the only amount of profit that's actually taxable is 50,000 rupees. See how powerful that is? It just cut your taxable income way, way down.
And now, for the final simple calculation. We take that taxable 50,000 and apply the 10% rate. Your final tax bill is only 5,000 rupees on a profit of 1.5 lakhs. I mean, think about that for a second. That's an effective tax rate of just a little over 3%.
Okay, we've talked about the good times, the gains. But what happens when a trade goes south? Well, understanding how to handle losses isn't just about feeling bad. It's a critical tax-saving strategy. This right here is the pro move. Pay close attention to this table because it's incredibly important. Look at the first row. A short-term loss can be used to cancel out both short-term and long-term gains. It's super flexible. But now look at that second row. A long-term loss can only be used against long-term gains. You cannot use it to reduce your short-term profits. That's a huge difference.
And that's exactly why, from a tax planning point of view, a short-term loss is way more powerful. It's like your secret weapon because it gives you so many more options to lower your overall tax bill since you can use it against either kind of profit.
So what happens if you have more losses than gains in 1 year? No problem at all. The law, specifically Section 70 and 74, lets you carry those losses forward for up to 8 years. But, and listen up, this is non-negotiable. You only get this incredible benefit if you file your income tax return on time.
Look, knowing the rules is one thing, but actually putting them into practice without making a mistake is a whole other ballgame. So let's quickly go over the common traps that investors fall into when it's time to file taxes.
Here are the big 4. First, forgetting that STT has to be paid. Otherwise, those special tax rates just don't apply. Second, thinking that the 1 lakh long-term exemption is per trade. It's not. It's a total limit for the whole year. Third, and this one really hurts, is not declaring your losses. If you don't report them, you can't carry them forward. You're literally throwing away a future tax break. And finally, filing late. As we just saw, that means you lose the right to carry forward losses, period.
And just to hammer this point home one last time, Section 139(1) of the Income Tax Act makes this crystal clear. If you want to use your losses to save tax in the future, you absolutely, positively must file your return on time. There's no way around this.
So there you have it, the complete breakdown. Short-term gains, long-term gains, and how to be smart about your losses. Think of these rules as tools in your investing toolkit. The real question is, now that you know how they work, how is this going to change your strategy? How will you plan your next buy or sell? Definitely something to think about.